newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. US President Donald Trump says NATO should shoot down Russian aircraft violating their airspace. He also struck a more sympathetic tone on Ukraine's chances of winning the war. In a social media post, Trump said he believed that Ukraine was positioned not only to fight back against Russia, but to reclaim all the territory taken by Russia. He voiced his support when he met President Macron at the UN General Assembly.
Most of you have seen the recent statement I put out a little while ago, and I'm glad you got it. But I feel that way. I really do feel that way. Let them get their land back.
Yep.
So we'll see how it all works out.
Well, let's bring in our Europe correspondent, Oliver Crook, then, for the latest. So certainly a change in rhetoric from President Trump, Ollie, now talking about Ukraine winning this conflict.
Not just winning it, Tom, reclaiming all of the territory that it has lost is something that basically the Trump administration from the very beginning, maybe not explicitly, but certainly in private conversations, saying was a fanciful sort of dream and that people needed to be much more realistic in their approach to dealing with this war. And even as recently as a few weeks ago when he met with Vladimir Putin in Alaska, really they were talking about territorial swaps and all these sorts of things. This is 180 degrees from, maybe not what we had a few weeks ago, but certainly what we had 7 months ago when you had these two presidents sitting in the identical configuration in the Oval Office, that catastrophic meeting between Zelensky and Trump, and now Trump talking very openly, basically, about the prospect of regaining all the territory. And again, later in the post, Tom, saying that maybe they could go even a little bit further, i.e., I guess implying that they could take some Russian territory. Now, when you get into that kind of conversation from these posts, you do have to ask yourself, is this really what Trump's position is? Is this a bit of hyperbole? Is this a bit of the art of the deal to, A, send a signal to the Ukrainians that the United States has their back, has their support, but also a signal to President Putin after having tried the sort of honey approach that something much sort of harder is coming. So regardless really of where this sort of this ends up in terms of these sort of concrete terms, at least what you have over the last 24 hours is a very, very positive signal. And Tom, I don't think we can sort of underplay how important that is to the morale of a nation that has been at war for over 3 years, and to the people in the front lines to hear the President of the United States, the main backer militarily of the Ukrainians since the beginning of this conflict, is back on their side.
OK, so a morale boost, arguably, for the people of Ukraine. We'll see, of course, to what extent President Trump sustains this new position in terms of Ukraine's prospects versus Russia. And all of this, of course, coming at a pretty tense time for NATO members, given the incursions by Russia into their airspace. What have we been hearing from those members in terms of how they plan to respond to any future incursions?
Yeah, Tom, they're really interesting here because you have sort of different perspectives from a lot of different people that we've heard. We heard from Donald Tusk, the Prime Minister of Poland, who was saying that basically anything that comes into our space, we will shoot down. We heard the similar messages from the Polish Foreign Minister. Again, Donald Trump was asked about this yesterday. What should the Europeans do if Russian aircraft are in their airspace? And he said that basically they should shoot them down. However, there are people that have taken a slightly more cautious tone, namely, for example, the Prime Minister of Estonia, with whom I spoke yesterday. Have a listen to what he had to say about a further incursion within their airspace and what their reaction would be to that.
NATO has protocols for that, and NATO has exact knowledge when something will happen. So we will follow the NATO's plans. And yes, we have the capabilities here because, to be honest, Russia's fighter jets were followed by Finns, and after that Italians coming from Estonia's side to push them out from our territory and air. But we have protocols and measures in place.
And I think as excited as everybody got about this idea about, where the red lines are and really wanting to represent those to Russia, the people that are actually on the front lines, like the Estonians, a nation of less than 2 million people who would really face the kind of direct brunt of this, take a much more sort of calculated approach to this. I should also say, just as a final point, the German defense minister came out saying something very different as well, saying that slapdash demands to shoot something out of the sky or do some great show of strength help less than anything else right now, and that basically this would play into the Russian calculation of trying to sort of create anxiety and to create escalation and then act like they are the aggrieved party. So really calling caution there from the Germans, who are, sort of increasingly the sort of main military power within Europe, particularly with the spending that they're going to do over the next couple of years.
OK, Bloomberg's Oliver Crook, thank you for that update in the context, of course, on that important story that we continue to monitor for you, Ollie, with the latest. Meanwhile, on macro policy, Federal Reserve policymakers giving mixed signals on the path ahead, clouding the outlook for interest rates. That was underlined by Chair Jerome Powell, who warned that risks remain for both the labour market and inflation.
Near-term risks to inflation are tilted to the upside, and risks to employment are tilted to the downside, a challenging situation. Two-sided risks mean that there is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished and need to reverse course later to fully restore 2% inflation. If we maintain restrictive policy too long, the labor market could soften unnecessarily. When our goals are in tension like this, our framework has long called for us to balance both sides of our dual mandate.
OK, let's bring in Bloomberg's Valerie Teitel right now. Val, how uncertain is the path ahead for the Fed?
Well, at least for Jerome Powell's mind, he is still flagging both sides of the risk to their dual mandate, standing quite out against other Fed speakers we've had this week. We've heard from the doves and the hawk. Powell is really focusing on putting himself right in the middle. It was just a few days ago we heard from the hawk, Beth Hammack, talking about the risks of the U.S. economy overheating if they cut too quickly. And then on the dovish side, we also heard from Michelle Bowman yesterday. She even said that there is a serious risk of the Fed falling behind the curve and is warning on any further labor market weakness that the Fed needs to amp up the pace of its rate reductions. Powell really talking about both sides of those risks, not really harping on either one, said a lot of the same kind of messaging he did just a week ago at the FOMC press conference. He did seem to jolt the equity market, though, to the downside when he was asked about equity market valuations. He did respond that equities do look highly valued on several metrics. So it did seem to the equity market just slightly yesterday, though, but it was just undoing Monday's rally. We are still trading basically flat on the week when it comes to S&P futures. But regardless of where the equity market is going this week, there is one asset that is continuing to see a breakout, and that is gold. We've had 3 straight days, Tom, of record highs for the yellow metal, or coming very close to making it a 4th. Is this geopolitics? Is this worries about the Russia situation? Or perhaps is it real money investors out there thinking they're underinvested on the yellow metal?
Yeah, this is a daily story, it seems. Bloomberg's Valerie Teitel. We'll see if it notches another record high, as you say. With a check there on the markets, the response, of course, to what we've been hearing from some of these Fed speakers, including Chair Jay Powell, and a further move higher for the yellow metal. I want to get back to one of the key corporate stories of the day, the catalytic effect coming through from Alibaba and the CEO and the company announcing plans to invest more than their previous target of $50 billion on infrastructure and the training of their new large language models. Also reports of a partnership with NVIDIA, which is intriguing. You can see the shares pre-market jumping more than 9% and really catalysing the view amongst the optimists that there is further to go in this AI theme. So continue to watch Alibaba on the back of that. Let's get back to the markets more broadly right now and bring in Johanna Kyrklund, CIO for Schroders, with a view on gold, interestingly, and we'll get to that, Johanna. But broadly across these equity markets, you've recently you've been constructive all year. You've turned more constructive in recent days. So you've upgraded your view on equities to positive. What underpins that, given concerns from some around valuations?
So generally, we've been positive on equities all year because our view is the sort of populist policies lead to higher nominal growth. This emphasis on fiscal policy that we've seen out of the United States is very positive for nominal growth. So it's a simple view, but it has been working. The reason why we reiterated that stance most recently is because I guess when we look at the Fed debate, we've erred more on the sort of things a bit too hot side of the equation. So we view the fact that they cut rates most recently as being, quite dovish relative to the reality of the labour market, which is still quite tight. So whilst we have a very reflationary policy mix now in the States, loose fiscal policy and now falling rates, ultimately that's very positive for equities. That's what drove it.
I understand the short to medium term thesis on that front, but do those policies come back to bite in 2026?
Absolutely. They do come back to bite because ultimately we are concerned about inflationary pressure rising again in 2026. And certainly if they cut rates too aggressively, we would view that as a policy mistake. So yes, I think that this might come back to haunt us in 2026. And that's why, on the other hand, we've also been bullish gold all year, because we see it as a very good counterweight to our positive view on equities.
So you don't think the run-up in gold, up 40% year to date, that's not looking too stretched for you? Is there a target in mind? How are you thinking about how the gold story evolves from here? You're suggesting that the window has not closed to those who don't yet have exposure to the yellow metal.
It's obviously harder if you haven't owned it so far. We've generally been positive for the last couple of years, because we think in this environment the ultimate constraint on all this sort of fiscal spending, including defence spending in Europe, the ultimate constraint ultimately is the bond market saying enough. And so gold is a good hedge against that risk. It also does well when real yields are falling. I think that's what's propelled it most recently. I think it's still a good position to hold.
How do you tie your view on gold, or at least how do you tie your view on the Fed to the dollar, and whether or not, what would you need to see a turn in the dollar, given the weakness that we've seen for the greenback?
Well, we need to see a stronger dollar, you mean?
So a stronger dollar, yes.
Yeah. We would need to see the Fed moving more hawkish. I think the flows generally we are seeing a number of institutional investors reviewing their US exposure, not because they're abandoning the US, but just because they're recognizing that maybe after many years of investing in the US, the exposure to the dollar might be too high in their portfolio as a starting point. So portfolio flows are going against the dollar, as far as I can see. The one counterweight to that is rate differentials. Again, we think the US economy is in fine shape. We see a low risk of recession. If the Fed doesn't end up cutting, as some people expect, rate differentials will be on the side of the dollar. So for me, it would be a return to that US exceptionalism where they continue to deliver better growth than expected. And that is a possibility.
OK, so continues to be a clear link between the rate environment and the dollar at this point. Of course, there is a view in Washington that President Trump will remould the Fed, maybe more in his image, and so the new Fed chair will be consequential in that. When it comes to the Treasury story, the yield story, is there part of the curve, Treasury curve, that you'd be comfortable sitting in right now? How are you comfortable in terms of how well priced or not the Treasuries are at this point?
At the moment, we're negative on bonds because, again, we have this view that the Fed shouldn't get too dovish here. So, the front end has started to price quite significant rate cuts in the United States, and we would be above the curve at the front.
Yeah.
And then the longer end is still somewhat challenged by the fact that people are concerned long term about the sustainability of government debt and the independence of the Fed. So a term premium is required in the bond market. So right now we're underweight duration.
What's your regional bias? US versus Europe versus EM?
On the equity side, we've been favouring the US. That's been a core view. Again, the US the reason why US exceptionalism is there is partly because of the tech story, but also because they're able to spend more fiscally than any other country in the world. We let them get away with it. On that basis, the US economy does well. So we're positive on the US, also positive on emerging markets. They benefit from a weaker dollar. And so generally we've been positive on emerging equities.
How much, you didn't mention AI in that view on the US. Do you have conviction in terms of how much further the AI momentum can run? I mean, it's now a significant component, or at least not an insignificant part of the growth story in the US, arguably, given how much has been committed to infrastructure spend.
Hard to time that one.
Yeah.
I think that, there are elements which are starting to feel a bit frothy on that story. But for now, I think the US remains dominant from a technology standpoint, and that's why it's a market that's hard to ignore. OK. The US, a market that is hard to ignore. Johanna Kyrklund, thank you very much indeed. Always appreciate your insights on these markets. CIO at Schroders. Coming up, we'll discuss the outlook for IPOs after a recent flurry of activity. Has the window now opened on these capital markets? Is there more to come? Size and shape of these deals? That is next. This is Bloomberg.
We think that the risk on inflation are very balanced. And we are in a good place. I mean, we are right on target. We will be close to target for the next 2 years. Inflation expectations are well anchored, so we are in a good place. And in terms of inflation, again, the risks are balanced.
OK, that was European Central Bank board member Piero Cipollone speaking, of course, to Bloomberg. Now, there has been a flurry of recent listings in Europe, a sign that tariff-induced caution that had disrupted deals has passed. Online marketplace firm SMG is Europe's largest IPO to trade so far this year. Alarm firm Verisure and Swedish financial services group Nova Bank are both set to debut in the coming weeks, and they'll be key, of course, to decoding the health of Europe's IPO market. Of course, we also had Klarna listing in the US. Let's bring in Gareth McCartney then, Global Co-Head of Equity Capital Markets at UBS. Gareth, thank you for joining us on the IPO story that has finally become interesting. Is this, how would you characterise this level of activity? Put it in its kind of historical context, I mean, particularly compared to the last couple of years. Are we back to kind of the normal when it comes to IPOs?
Look, I think we're on the path to normal. The IPO market traditionally is very cyclical. We had a super peak in 2021, and then unusually we had pretty much 2 to 3 years of the market being effectively closed. 2024 was really the definitive reopening of the IPO market, particularly here in Europe with some larger issuers. And I would say now we're running roughly up 50% year on year in terms of volumes. But importantly, if you take the 5-year average, we're still 30-40% below that. So I think we're on the path to normalization. And my expectation is the remainder of this year and 2026 will be a normal functioning IPO market.
OK, a normal functioning IPO market towards the end of this year and into 2026. But given what you said about the fact that essentially the IPO markets were closed for 3 years, does that suggest the pipeline activity is going to pick up, that there have been all these companies waiting on the sidelines, ready to list, and that the pipeline is going to look more robust in the years ahead?
Yeah, absolutely. I think, look, we brought forward a lot of the pipeline in 2021. Right. And I think that explains some of the anemic activity we saw in 22 and 23. If we look at it today, what's encouraging to me is, A, this is a global phenomenon. We've got Asia, US and Europe all open concurrently. There's some quite good themes underlying it for secondary market investors to participate in. I think whether you look at fintech, whether you look at AI, whether you look at software, and then I think here in Europe, the infrastructure and the defense spending with the fiscal growth we're seeing. So there are multiple themes for investors to play. This is not just a one single theme event. And ultimately, you're looking at the US for growth, and I think Europe and Asia for more traditional companies.
Are the IPOs that we've seen so far year to date very idiosyncratic, or they're common on similar traits amongst those listings?
I think we're building some common traits. I think business services is always a nice market where the private equity groups tend to have some pretty good assets that come to market. SMG is a very good example of that in terms of growth in the classified space. I think there's a cluster of fintech opportunities globally, which will continue to be interesting. Klarna was a very good example of that. So I think what we are seeing, though, is still an investor base that is in selective mood. They want larger assets where there's bigger liquidity in the aftermarket, which helps de-risk a little bit. And secondly, they really want to see very strong equity story supported by growth.
How would you characterise the liquidity environment right now?
Yeah, liquidity environment's never been better. I think I keep a very close eye on M2 money supply in the US. We're running up another 5% this year. You only need to look at the Fed potentially to cut rates further. And certainly when we talk anecdotally to investors, they have significant amount of capital to deploy, and they're really struggling to keep up with equity markets, which are again up double digits this year. So the IPO market, and I think ECM issuance in general, is a great way for them to deploy that capital. So this is not a supply side of cash story. This is much more about a supply side of good, interesting companies coming to market.
Does that suggest there's some resilience if we get a place, we're at record highs approximately for global stocks? Some are getting a little concerned about how far things have run.
Yeah.
If we were to get a correction, does that derail the activity we're seeing, or is there some resilience to that?
Look, I think there's resilience for a few reasons. Number one, every IPO comes down to its explicit equity story. Number two, the cash call we require from the market for IPOs is not significant in the broader picture. And three, if you look at preconditions for issuance, you want the VIX generally to be quite low and sustainably low, because IPOs are quite a long-term project from a strategic decision-making perspective. And you've got good multiples that you're comparing the companies to. So we've had a 50-60% move up in the US over the last 24 months or so. I think there's quite a good cushion for residual valuation. And really, therefore, it comes down to us bringing good stories to the market that are liquid, have a good equity story, and an investor base that's got cash to deploy to it. But critically, this is not 2021 that we're in right now. This is still a selective market.
Someone seems to have lit the fire under Stockholm for IPOs.
Yes.
It seems to be booming on that front, or at least doing very well. Why? What is Stockholm getting right? What is the attractive value of Stockholm at this point?
Stockholm's always been attractive, I think, because there's a deep pool of high-quality, long-only domestic money. So I think with retail there, it's helpful, but I think you've got a domestic investor base, whether it's the pension funds or some of the traditional actively managed long-only funds, that therefore can really form an attractive shareholder register for potential companies to come. And I think the last point is the governance has always been very strong in Stockholm. So international investors want to invest in high-quality companies in the region, knowing they're investing alongside a strong domestic investor base.
OK, we'll see if UK regulators are looking at Stockholm as a potential case study. They're trying to get more pension money into the equity story here, into the capital markets of the UK. Klarna, though, obviously, famously a Swedish fintech, very successful, listing, of course, choosing New York to list, not Stockholm. Do you still see more European companies, particularly within the tech space, choosing New York over Europe in the near to medium term?
Look, there's no doubt there's a halo effect around growth stocks going to the US. There's many reasons for that, I think, in terms of the depth of capital base, perhaps the comparables. There are more stocks that are listed there, so it's easier from an investor perspective to pin a valuation relative to an existing listed company. That said, we have had very good examples in the UK and Europe of excellent stories, whether it's Adyen or Avast, for example, where investors have been very happy to support those companies in Europe to list. They've supported them in the aftermarket, and they've delivered compelling valuations. So for me, it's not a relative valuation story. It's not a relative lack of investor base or understanding in Europe. I think it's just you've had a cluster effect where growth has done well in the US. It's the right home for it. And therefore, I think as we go forward, it will come down to specific strategic reasons for where that company wishes to list. Yeah. But fundamentally, Europe works for good stories, and the US works for good stories. It comes down to individual
Really interesting nuance. Gareth McCartney with those insights, of course, Global Co-Head of Equity Capital Markets at UBS. Thank you. Plenty more coming up. We're going to bring you the president of the IFO Institute on the back of the latest survey. This is Bloomberg. Good morning. Welcome to the Pulse. I'm Tom Mackenzie in London. These are your top stories. President Trump says Ukraine could reclaim all territory lost in its war with Russia, adding that NATO should shoot down Russian aircraft violating their airspace. Fed Chair Jay Powell reiterates there is no risk-free path for the central bank, while Governor Michelle Bowman says the Fed is in danger of falling behind the curve and must act decisively. Plus, Alibaba soars after announcing plans to ramp up AI spending as the company confirms a collaboration with Nvidia. Now, German business confidence unexpectedly dropped for the first time since April. It highlights, of course, the fragility of Chancellor Friedrich Merz's plan to restore growth in Europe's biggest economy. Joining me now is Clemens Fuest, president of the IFO Institute. Clemens, always a pleasure to speak to you on the back of this survey and the updates. What do you point to when it comes to this unexpected slowdown in the business sentiment of Germany?
Good morning, Tom. Yes, it's an unexpected setback. And what we see is that mood in the service sector has worsened, and that's really a surprise because the service sector was the one sector that was relatively stable in recent years. And now we see a setback here. We see it in transport and logistics, for instance. Of course, that's closely related to manufacturing. And in the manufacturing sector, the weakness continues. So in recent months, there was some optimism coming up because companies expected the government to spend more, and they expected the new government to reform the economy. And now companies realize a lot of the borrowed money is actually going to consumption to plug holes in the budget. And there are few plans for credible reforms. And that explains the decline in the index.
OK, so there's a lot to unpack there, but this is a resetting, arguably, of expectations amongst the business community then, given what they thought was coming down the pipe in terms of those spending pledges on infrastructure and defence. That is still part of the plan of the Chancellor and this government. So I guess my question is this a short-term dip, Clemens, before that fiscal stimulus comes through, or is this something more profound, more structural?
Well, one would hope it's just a dip, but I'm afraid it could be structural. The trouble is we see that the government, yes, increases investment in the new fund, in the new debt finance fund, but cuts investment in its core budget. So it's really using the funds to plug holes in the budget. It's using them for government consumption. It's exactly a development where experts had warned. IFO has also warned. I mean, this is something that shouldn't happen. Of course, money is fungible. So the trouble is, if that happens, the infrastructure investment will just not be forthcoming. The money will be spent on consumption, and people are worried about that. We also see that the government doesn't really come up with plans to address the most pressing structural issues. For instance, pension reform. We all know that due to demographic change, there will be increasing spending on pensions, and that will drive up the taxes if there is no reform. But this reform is just not forthcoming, and it seems that companies are now realizing this and are worried about the consequences.
Okay, so the lack of reform is an issue as well. Across the different sectors that you look at, Clemens, I mean, clearly there has been pressure on chemicals, on the auto sector, construction to some extent as well. Are those still the pain point industries and sectors? What are you seeing in terms of the nuance between different parts of the German economy that stand out to you?
In the data today, it's really a weakness across the board. And what's joining the weakness now is the services sector. That used to be a more stable sector, but we see that services are weakening as well. What we also see in the data is an uptick in uncertainty perceived by companies. And as we all know, if companies think the world becomes more uncertain, they tend to invest less. In manufacturing, we have seen the weakness in incoming orders for some time, and that's related to the weakness in exports. Usually, after a downturn, the German economy recovers, driven by industry, driven by exports, and that's not happening this time, and that's worrying.
Clemens, where are we in terms of the ability for German enterprise, German industry to adjust to the tariff regime imposed by the Trump administration? We have the deal, of course, between Brussels and Washington. Where are we on adjusting to those higher tariffs?
Companies are adjusting. We see some weakness in export to the United States, so there will be fewer exports. The trouble is that for a permanent adjustment that would create a basis maybe for new investment, for improvements, companies need certainty, and they don't really trust the deal between the US and Europe. They still think maybe the US government will change tariffs again. So there is a lack of reliability, and that makes things difficult. At the same time, German companies, the traditionally strong sectors, machinery, cars, these sectors are losing competitiveness relative to other nations, in particular China, and that is felt across the board in exports, not just in the US market, but globally.
The ECB has managed to get rates down to 2%. Inflation has certainly been tame, certainly when you look at the UK versus Europe. Does the rate environment prove a catalyst? Are there industries that are starting to see the benefits, at least, of lower rates?
There certainly are. This is certainly a positive factor, and perhaps even the prospect of further rate cuts if the economy continues to slow, and tariffs could be a factor for that. We think there would be room for more rate cuts. Of course, Germany is at the lower end of the European economy, so growth is a bit stronger in other countries, and the ECB does monetary policy for the Eurozone as a whole. So it's not quite clear whether this monetary policy is really tailored to the German situation, something we need to live with. But still, I would say the interest rates are maybe not the key concern. Debt levels of German companies are relatively low still, of most German companies at least. So lower rates would be welcome, probably more for the construction sector than for manufacturing. But it's not, I would say it's not the most important factor.
Clemens Fuest, President of the Info Institute, thank you very much for your time with the German business outlook declining for the first time since April. So we touched on the auto sector of Germany. Now let's switch focus to the UK and that sector here. Jaguar Land Rover is trying to clear a backlog of payments owed to suppliers. It's due to a crisis caused by a cyber attack that's brought the car makers' factories to a standstill. Joining me now is Bloomberg's UK business editor, Jamie Nimmo, who focuses on autos in granular detail, and, of course, the JLL saga. So the impact of the cyber attack, and now it's having secondary and tertiary effects as well, Jamie. How significant is this?
Yeah, quite significant. I mean, the auto sector in Britain is very reliant on JLR. It's the biggest car maker by some distance. And what we're seeing now is it's lasting for more than 3 weeks into next week, so that's at least 4 weeks. That's having this knock-on effect on suppliers that are completely reliant on JLR, especially small ones, which make anything from, could be a seat, could be exhaust systems, could be anything. We're talking hundreds of suppliers. And that is having, well, it will ultimately have a knock-on effect on the other car makers that rely on those suppliers. So it's quite significant.
So there is that broader impact across the sector, given the size and scale of JLR within the UK auto industry. Is there any indication as to when they can restore production? I mean, as you say, 3 weeks is pretty remarkable in terms of the length of time this has gone on, and then all the impacts as a result of this. When do they manage to get back on the right footing and solve this issue?
Yeah, so last week they hoped to be up and running today.
Right.
That hasn't happened. Yesterday they extended that by another week. Now, there are reports that say it could last into November and then potentially not completely up and running again until maybe even New Year. Now, Jaguar Land Rover is pushing back on this, saying that we will be up and running. But you know, these sort of things take time. And we saw with the Marks and Spencer attack earlier this year, it took them months to get up and running and to get full produce in the stores, in their retail stores regularly. So it really could have a sort of longer term impact. And that's, you know, big blow for Jaguar Land Rover, but big blow for all those suppliers who are going to be reliant on that business. OK, Jamie, fantastic update. Thank you very much indeed. We'll see if they can turn things around quicker than the new year. Jamie Nimmo, Bloomberg's UK business editor, thank you. Switching focus now to what's happening in the Middle East, particularly with a lens on the equity markets there, because stocks in Saudi Arabia are soaring on a Bloomberg report that the kingdom may soon allow foreigners to own majority stakes in local companies. Right now, there is a cap of 49% for listed firms. Bloomberg's Saudi Arabia bureau chief, Christine Burke, joins us now from Riyadh. Christine, what more do we know about this? This could be pretty seismic.
Yeah, it could be seismic, and we're definitely seeing the market reaction today indicate just how big this could be. Already, Saudi Arabia's market capitalization today has jumped by more than $120 billion. So we had an exclusive opportunity to sit down with the CMA, and what the CMA told us is that they are currently reviewing the rules of majority foreign ownership of Saudi stocks. As you mentioned, they currently stand at about 49%, but they're looking to remove that so foreigners could come in and be majority owners. Now, we do not know how high the Saudis could eventually go, but we are told that they expect some kind of decision to come into effect before the end of the year. So this is pretty significant. It is one in a series of moves the Saudis have taken recently to try to draw more foreign investor capital into the market, but the most dramatic and significant one yet, because this would be the first time ever that foreigners would be able to have majority ownership in a local Saudi firm.
What is the broader significance then of this change and what it signals about the reforms of this Saudi government?
Well, I mean, I think it keeps with the theme of the fact that Saudi Arabia keeps continually saying it is open to the world. And that's exactly what we're seeing when it comes to many things in the kingdom, but with the capital market specifically. Why this is such a significant deal is that the MSCI weighting of Saudi would go up if they remove this foreign ownership limit. So that stands to bring in billions in dollars worth of inflows to the Saudi market just by default and the changing of the calculations. JP Morgan today has said it expects $10.6 billion of inflows. EFG Hermes, another firm that is saying it expects $10 billion. And it is expected that we will see Saudi banks be the biggest beneficiaries of this. On top of the actual effect to the market directly, I think there's a psychological hurdle that you remove here. I mean, if foreign investors previously looked at the Saudi market and knew they couldn't have majority ownership, then perhaps that, created some hesitation to get involved. Already a number of investors have been saying to me this morning that this could pave the way for more cross listings, for more M&A, and just for more investors to look at getting more deeply into this market that's opening up to the world.
OK, there we go. Significant changes afoot, potentially, as the Saudis look to some of those ownership changes. Saudi Arabia bureau chief with the details, Christine Burke, thank you very much indeed for that update. Also making the news this Wednesday, Super Typhoon Regasa is set to cross China's southern coast later today after battering Hong Kong with torrential rain and 195-kilometre-per-hour winds. It has already left a trail of destruction. At least 14 people have died in Taiwan. More than 100 are missing, and at least six people have died in the Philippines. Alibaba shares surged to their highest in nearly 4 years after revealing plans to ramp up AI spending. Chief Executive Officer Eddie Wu says Alibaba needs to keep up with the $4 trillion worldwide AI spending he sees over the next 5 years. Alibaba is also integrating NVIDIA's suite of AI tools into its cloud software platform. Meantime, Cathie Wood's funds reopened positions in Alibaba for the first time in 4 years on optimism over the Chinese firm's push in artificial intelligence. And Micron, the largest US maker of memory chips, has given an upbeat forecast saying AI has boosted demand, but the company warns that spending will go up as it tries to keep up. Micron says it expects the supply to remain tight into next year. Demand for data center equipment is stretching the ability of companies to keep up with orders. And Tether is said to be in talks with investors to raise as much as $20 billion. Sources say the El Salvador-based crypto firm is seeking the funds for a roughly 3% stake through a private placement. That could value the issuer of the world's largest stablecoin at around $500 billion, ranking it among the world's most valuable private companies. And US late-night host Jimmy Kimmel became notably emotional as he returned with his show to TV. Disney suspended Kimmel's show last week following controversial remarks the comedian made about the assassination of Republican activist Charlie Kirk. At the start of his ABC show, the comedian thanked both political supporters and opponents who had backed his freedom to share his views on air before offering this conciliatory message.
And the truth is, I don't think what I have to say is going to make much of a difference. If you like me, you like me. If you don't, you don't. I have no illusions about changing anyone's mind. But I do want to make something clear because it's important to me as a human, and that is, you understand that it was never my intention to make light of the murder of a young man.
Well, Kimmel went on to call the push to take his show off air un-American. In a social media post, President Trump floated the prospect of unspecified future legal challenges against the decision to bring back the show, calling him an arm of the Democratic Party. Coming up, AI-enabled software that is powering a new vision for defence drones. A significant deal. We will bring you the details next. This is Bloomberg.
My advice always as a Finn is to stay calm in these kinds of situations and build up a deterrent which gives a disincentive for Russia to continue. But when they continue, stay calm and deal with it.
The President of Finland, Alexander Stubb, on these interventions, of course, by Russian aircraft into the airspace of NATO members. Let's check in on defence stocks right now because they are getting a lift on the back of some of the commentary out of the United Nations, particularly President Trump and his suggestion that NATO members could consider shooting down Russian jets if they intervene again in NATO member airspace. And, of course, NATO members trying to align the response should that happen again. So some of those defence stocks that have performed very well year to date, up again in the session today. Rheinmetall, gains of 2.2%. Leonardo, of course, over in Italy, gains of more than 3% right now. Thales and BAE Systems, all part of that mix as well. Let's continue on the defence story. And what a salient moment to talk about this, given the concerns, the anxiety around those interventions by Russia into NATO member airspace, because a startup that provides software for military drones has raised $130 million to expand its operations abroad. Auterion Software gives uncrewed aircraft better navigation and targeting capabilities, which makes drones cheaper and more effective with its autopilot and tools for swarming Alex Ferrara, partner at Bessemer Venture Partners, who led the financing round, joins me now. Alex, thank you for joining us in the studio.
Thank you.
On the back of this deal, and again, at a time, of course, where we're all trying to think about how NATO should respond to the interventions, and clearly drone technology is going to be part of that, if not now, then into the future. What does Auterion do? Why did you back this company in particular? So many different drone makers out there and defence tech startups right now. Why Auterion? What do they do that differentiates them?
Sure, you're absolutely right. So it's a very crowded space. There are a tremendous number of drone companies as we've started to look at the market. But Auterion is really providing the operating system. They're sort of the Microsoft or the Android operating system for the drone industry. Lorenz Meyer, the CEO, invented Mavlink and a set of open source products that are the core flight control systems for a lot of drones. I think they power something like 95% of the drones out there. So we were excited about it because we like to invest in software, and this software is the operating system and to some extent the app store that enables the entire, we hope will enable the entire industry.
Where are they in terms of acceptance? To what extent are defence companies and governments looking at this solution right now? What is the momentum they're seeing?
Well, at the most basic layer, the lowest common denominator, this flight control software, they power, again, like 95% of the drones out there. As you move up the stack to more advanced capabilities like terminal guidance, which is used for guidance in GPS denied or GNSS denied environments, they also provide a large number of drones with their technology. They've partnered with a host of the primes, including Rheinmetall and Lockheed and some others, and they're now being used with, I think, something on the order of tens of thousands of drones in Ukraine on the battlefront, both for reconnaissance and surveillance, as well as for other sorts of missions.
And to be clear, those tens of thousands of drones in Ukraine and elsewhere, the software allows different hardware, different drones made by different companies.
That's right.
And it allows interoperability between all those different drones.
That's exactly right. So as long as their software is being used across a heterogeneous fleet of drones, they can synchronize. And a more recent version that they've released now allows drone swarms. So you can have an operator control tens or hundreds of drones simultaneously in a swarm mission.
How are the primes, so how are the main defence contractors viewing Auterion? You talk about Rheinmetall, the partnership there. So are they more of a partner or more of a threat?
More of a partner. So we are not looking to disrupt any of the primes in any way. We are a partner to the primes. Our technology is software, it's AI based, and it's really meant to enable capabilities that were previously impossible, such as this kind of drone swarming capability that the primes, from what I understand, don't currently have for the types of small, low-cost drones that Auterion is powering today. But over time, I think the hope is that they're going to both partner with the primes and enable and fill that gap that the primes haven't, today, at least put resources behind themselves.
They have a contract with Pentagon. They have a contract with Taiwan.
That's right.
Other contracts in the pipeline with national governments?
Yep, absolutely. They've got. That's one of the things that got us very excited about the business and caused us to make this preemptive offer to invest. They have a really exciting pipeline of opportunities in addition to on the order of 100 million of revenue that they're generating.
What's the most likely exit outcome for a company like this? I mean, they get bought by Rheinmetall. They list, private equity comes in. I mean, realistically, we haven't seen any major exits within defence tech recently.
That's right. It's so early, right? I mean, even at 100 million of revenue scale, we consider this a Series B investment. Yeah. We look to invest in these companies for a decade or more. Some of our companies have taken 15 or more years before they've gone public. Our company StubHub went public just last week is a good example of that. So it was around for 20 years. So we take a very long-term view. We're not thinking about the exit today. However, I will say when you look at some of the public markets, we think they're becoming increasingly receptive to these kinds of companies. We think there's going to be a whole host of newer primes that emerge that are software and AI based. And even if you look at the existing primes, Rheinmetall, you mentioned, at the beginning of this, their stock price is up something on the order of 25 times in the last 3.5 years. We look at that and say, wow, that's a venture return. We'd love to be, have investments like that. And so our hope is that whether it's an M&A outcome or an IPO outcome or even a secondary at some future point, much like we see with later stage companies, that there are many paths.
And you talked about the fact that Auterion wants to be the app or the Microsoft of the drone world. On the drone makers themselves, interesting, the CEO of Rheinmetall recently came out and said he sees a bit of a bubble. Mm-hmm. Does that align with what you're saying? There's so many companies producing these drones, whether it's a Helsing or a Anduril or many others, Quantum Systems. Is it looking a bit bubbly in terms of the makers of these drones?
Yeah, it is. It's really always difficult to tell when you're, maybe we're in the bubble, maybe we're not. However, I think what we have seen is that the nature of warfare has changed. I think the Ukraine war has really demonstrated that. Not only the use of AI, the use of these kinds of low-cost drone capabilities, but the economic equation has changed as well. When you've got these low-cost drones that are able to take out high-value targets, whether that's a tank, whether that's a radar installation on a battleship, that really changes the game. And so we see that as disruptive and an opportunity. And I think that's one of the reasons why there's so much competition and interest in this market. So
what is your understanding of where our adversaries are on this front? I'm thinking of the supply chain advantages that China has when it comes to producing drones and the engineering talent they have on the software front. To what extent do we have a moat at all when it comes to China's capabilities?
Right. Well, that's actually a big part of one of our broader investment theses, which includes defense tech, space tech, and building out the advanced industrial manufacturing base. Because I do think across Europe and the Western world, we have, in many areas, lagged behind China. And I don't think it's an unassailable challenge. I think we're, working to catch up. But there's no question that when it comes to the production of some of these drone capabilities, robotics, and so forth, China is fairly far ahead, at this point. Now, our hope is that technologies like Auterion will enable each of the individual countries to build out their own individual defense industrial bases. So we can let 1,000 flowers bloom. There'll be, production in each of these locations powered by the intelligence that Auterion is providing.
When you think about how this whole this technology evolves into the future, and we're thinking about drone swarms. We're talking about different national defence capabilities. I mean, clearly the need is there. Do you ever get a little bit concerned around how this technology is advancing? I mean, fine if it's defending us, but it can be very easily turned upon us.
Absolutely. It's something I think we need to think about. First, I'd point out that the substantial majority of the usage for this technology historically, from what we've gathered, has really been more ISR. It's intelligence, surveillance, reconnaissance. It's really used to gather information about troop buildups at a border or other activities of interest. And certainly these technologies are used for kinetic missions, as they call them. But our sense is also that this is to some extent deterrence. Okay. Like over time, both sides having these capabilities will be a positive.
Alex, really appreciate you coming in on the back of that deal. Alex Ferrara, partner at Bessemer Venture Partners. The EU's Foreign Affairs representative will be speaking to Bloomberg Tech, 4 p.m. London time. Up next, it's Bloomberg Brief. This is Bloomberg.